Chapter 14, Relevant Costs for Decision Making. Making decisions is one of the basic functions of a manager. To be successful in decision making, managers must be able to tell the difference between relevant and irrelevant data and must be able to correctly use the relevant data in analyzing alternatives. So the purpose of this lecture is to develop these skills by illustrating their use in a wide range of decision-making situations. So learning objective number 1 is to identify relevant and irrelevant costs and benefits in a decision. A relevant cost is a cost that differs between alternatives. An avoidable cost is a cost that can be eliminated in whole or in part by choosing one alternative over another. Avoidable costs are relevant costs. Unavoidable costs are irrelevant costs. Two broad categories of costs are never relevant in any decision. A sunk cost is a cost that has already been incurred and cannot be avoided regardless of what a manager decides to do. A future cost that does not differ between alternatives is never a relevant cost. So, relevant cost analysis is a two-step process. The first step is to eliminate costs and benefits that do not differ between alternatives. These irrelevant costs consist of sunk costs and future costs that do not differ between alternatives. The second step is to use the remaining costs and benefits that do differ between alternatives in making the decision. The costs that remain are the differential or avoidable costs. Costs that are relevant in one decision situation may not be relevant in another context. Thus, in each decision situation, the manager must examine the data at hand and isolate the relevant costs. Assume the following information with respect to Cynthia, who is a Penang, Malaysia student who is considering visiting her friend in Kuala Lumpur, Malaysia. Cynthia is trying to decide whether it would be less expensive to drive or to take the plane to Kuala Lumpur. She has compiled the following information with respect to her automobile. The straight line depreciation is calculated as cost minus salvage value divided by useful life. Gasoline per mile is calculated by taking the price per gallon of gasoline and dividing it by the number of miles per gallon of the car. The annual cost of insurance and license and maintenance and repairs are also included to arrive at the average cost per mile. The parking fee at the school is $45 a month. Cynthia attends school only 8 months of the year. She has also gathered additional information to aid in her decision, such as the reduction in resale value per mile driven, round-trip airfare, benefits of relaxing on the plane, cost of putting her dog in the kennel, benefits of having a car in Kuala Lumpur, hassle of parking in Kuala Lumpur, and per-day cost of parking in Kuala Lumpur. Some of these items can be measured in dollars and some can't. Which costs are relevant to her decision? The cost of the car is irrelevant to the decision because it is a sunk cost. The annual cost of auto insurance is irrelevant because it does not differ between alternatives. The cost of the gasoline is relevant because it is avoidable if she takes the plane. The cost of maintenance and repairs is relevant because in the long run these costs depend upon miles driven. The parking fee at school is irrelevant because it is not a differential cost. At this point, we can see that some of the average cost of 61 cents 0.9 per mile are relevant and others are not. The decline in resale value is relevant due to the additional miles driven. The round-trip airfare is relevant because it is avoidable if she drives her car. Relaxing on the plane is relevant but difficult to quantify. The kennel cost is irrelevant because it's not a differential cost. The cost of parking in Kuala Lumpur is relevant because it is avoidable if she takes the plane. The benefits of having a car in KL and the problem of finding a parking space are both relevant but difficult to quantify. From a financial standpoint, Cynthia would be better off taking the plane, but as with any decision we may face, it may be the non-financial or non-quantitative factors that have the most impact on our decision. Assume the following information for a company considering a new labor-saving machine that rents for $3,000 per year. The total approach requires constructing 2 contribution format income statements, one for each alternative. The difference between the 2 income statements of $12,000 equals the differential benefits shown at the bottom of the right-hand column. The most efficient means of analyzing this decision is to use the differential approach to isolate the relevant costs and benefits as shown. Using the differential approach is desirable for 2 reasons. First, only rarely will enough information be available to prepare detailed income statements for both alternatives. Second, mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. So learning objective number 2 is to prepare an analysis showing whether a product line or other business segment should be dropped or retained. One of the most important decisions managers make is whether to add or drop a business segment. Ultimately, a decision to drop an old segment or add a new one is going to hinge primarily on the impact the decision will have on net operating income. To assess this impact, it is necessary to carefully analyze the costs. Let's assume that Lowell Company's digital watch line has not reported a profit for several years. Accordingly, Lowell is considering discontinuing this product line. To determine how dropping this line will affect the overall profits of the company, Lowell will compare the contribution margin that would be lost to the cost that would be avoided if the line was to be dropped. Lowell should drop the digital watch segment only if its profit would increase. This would only happen if the fixed cost savings exceed the lost contribution margin. Assume a segmented income statement for the digital watches line is shown here. An investigation has revealed that the fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital watch line. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. The equipment used to manufacture digital watches has no resale value or alternative use. So should Lowell retain or drop the digital watch segment? A contribution margin approach reveals that the contribution margin lost, which is $300,000, exceeds the fixed costs avoided, which was $260,000, by $40,000. Therefore, Lowell should retain the digital watch segment. The Lowell solution can also be obtained by preparing comparative income statements. Let's see how this approach works. These income statements show that if a digital watch line is dropped, the company loses $300,000 in contribution margin. The general factory overhead would be the same under both alternatives, so it is irrelevant. The salary of the product line manager would disappear, so it is relevant to the decision. The depreciation is a sunk cost. Also remember that the equipment has no resale value or alternative use, so the equipment and the depreciation expense associated with it are irrelevant to the decision. The complete comparative income statements reveal that Lowell would earn $40,000 of additional profit by retaining the digital watch line. Lowell's allocated fixed costs can distort the keep-drop decision. Lowell's managers may ask, why keep the digital watch segment when it is segmented income statement shows a $100,000 loss? The answer lies in the way common fixed costs are allocated to products. Including unavoidable common fixed costs in the segmented income statement makes the digital watch product line appear to be unprofitable, when in fact, dropping the product line would decrease the company's overall net operating income. Prepare a make or buy analysis. When a company is involved in more than one activity in the entire value chain, it is vertically integrated. A decision to carry out one of the activities in the value chain internally rather than to buy externally from a supplier is called a make or buy decision. Vertical integration provides certain advantages. An integrated company may be able to ensure a smoother flow of parts and materials for production than a non-integrated company. Some companies feel that they can control quality better than producing their own parts and materials. Integrated companies realize profits from the parts and materials that they choose to make instead of buy. The primary disadvantage of vertical integration is that a company may fail to take advantage of suppliers who can create an economies of scale advantage by pooling demand from numerous companies. While the economies of scale factor can be appealing, a company must be careful to retain control over activities that are essential to maintaining its competitive position. Assume that Essex Company manufactures part 4A with a unit product cost as shown. Also assume the following information. Given these additional assumptions, should Essex make or buy part 4A? The avoidable costs associated with making part 4A include direct materials, direct labor, variable overhead, and the supervisor's salary. The depreciation of special equipment represents a sunk cost. Furthermore, the equipment has no resale value, thus the special equipment and its associated depreciation expense are irrelevant to the decision. The general factory overhead represents future costs that will be incurred regardless of whether Essex makes or buys Part 4A. Hence, it is also irrelevant to the decision. The total avoidable costs of $340,000 are less than the $500,000 cost of buying the part, thereby suggesting that Essex should continue to make the part. An opportunity cost is the benefit that is foregone as a result of pursuing a course of action. These costs do not represent actual cash outlays, and they are not recorded in the formal accounts of an organization. In the Essex Company example that we just completed, if Essex had an alternative use for the capacity that it used to make Part 4A, there would have been an opportunity cost to factor into the analysis. The opportunity cost would have been equal to the segment margin that could have been derived from the best alternative use of the space. The opportunity cost can be derived by using the Deprival value model, also known as value to business and value to owner. It is often asked why inventories are not valued at the opportunity cost foregone during the decision-making process. When an asset which can generate higher economic value than selling them directly, the value of the asset to the owner or business would be the economic value foregone should the company decide to sell it, or vice versa when the recoverable amount from the selling asset is higher. For the decision-making process, the asset should be valued at the higher or opportunity cost between the two options. This decision has assumed that the asset is not replaceable at a lower value, or it is a scarce resource which cannot be replaced with ease at a lower value. If the asset is replaceable at a lower value than the economic value or the net realizable value, its owner is not deprived of owning the asset. The owner can develop a trade by continuous buying of the asset to create the additional economic value or net realizable value, making profit out of the transactions. The cost of the asset to the company is actual, the replacement cost in this case, as the company has not foregone the opportunity. The Deprival value model summarizes the above neatly and clearly in a simple diagram shown in the slide. In this example, without the Deprival value model, some people cannot differentiate the maximum foregone and the irrelevant information. With the Deprival value model, most people can find the opportunity cost of the scenario. So the example can be used with change of the figures just to test our understanding. What if the current price of the leather is only $350? The relevant value of the leather for the decision-making purpose should be $350 in this case. This can be resolved by using the Deprival value model on the following slide. The valuation chosen also matches with the financial accounting requirement of inventory being valued at the lower of cost or market. So putting the figures into the Deprival value model can help students to identify the true value, including the opportunity cost of using the leather for book bounding. If we change the market replacement cost to $350, then the Deprival value would change to $350 as the leather cannot be valued over its market value based on the accounting rule, lower inventory cost or market value. Furthermore, a trading opportunity may exist to buy and sell the leather to compete with the desk covering material. All inventories for trading are valued based on lower of cost or market value. So learning objective number 4 is to prepare an analysis showing whether a special order should be accepted. A special order is a one-time order that is not considered part of the company's normal ongoing business. So when analyzing a special order, only the incremental costs and benefits are relevant. Since the existing fixed manufacturing overhead costs would not be affected by the order, they are not relevant. Assume the following information with respect to a special order opportunity for Jet Corporation. Should Jet accept the offer? A contribution format income statement for Jet's normal sales of 5,000 units is as shown. Assume variable cost is $8 a unit. Total variable cost would be 5,000 units times $8 a unit. If Jet accepts the special order, the incremental revenue of $30,000 will exceed the incremental costs of $24,000 by $6,000. This suggests that Jet should accept the order. Notice that this answer assumes that the fixed costs are unavoidable and that variable marketing costs must be incurred on the special order. Let's do a quick check. Northern Optical ordinarily sells the X lens for $50. The variable production cost is $10. The fixed production cost is $18 per unit, and the variable selling cost is $1. The customer has requested a special order for 10,000 units of the X lens to be imprinted with the customer's logo. This special order would not involve any selling costs, but Northern Optical would have to purchase an imprinting machine for $50,000. So what is the rock bottom, or the absolute minimum price below which Northern Optical should not go in its negotiations with the customer? In other words, below what price would Northern Optical actually be losing money on the sale? There is ample idle capacity to fulfill the order, and the imprinting machine has no further use after this order. $15 is the average cost per unit. See how it was calculated. Learning objective number 5. Determine the most profitable use of a constrained resource and the value of obtaining more of the constrained resource. When a limited resource of some type restricts the company's ability to satisfy demand, the company is said to have a constraint. The machine or process that is limiting overall output is called the bottleneck. It is the constraint. Fixed costs are usually unaffected in these situations, so the product mix that maximizes the company's total contribution margin should ordinarily be selected. A company should not necessarily promote those products that have the highest unit contribution margin. Rather, total contribution margin will be maximized by promoting those products or accepting those orders that provide the highest contribution margin in relation to the constraining resource. Assume that Ensign Company produces 2 products and selected data is shown as on the screen. In addition, assume that machine A1 is the constraint and there is excess capacity on all other machines. Machine A1 has a capacity of 2,400 minutes per week. Should Ensign focus its efforts on product 1 or product 2? How many units of each product can be processed through machine A1 in 1 minute? One unit of one product and 2 units of product 2. What generates more profit for the company, using 1 minute of machine A1 to process product 1 or using 1 minute of machine A1 to process product 2? With 1 minute of machine A1, we could make 1 unit of product 1 with a contribution margin of $24, or 2 units of product 2, each with a contribution margin of $15. As suggested by the answer to quick check question, Ensign should emphasize product 2 because it generates a contribution margin of $30 per minute of the constrained resource relative to $24 per minute for product 1. Ensign can maximize its contribution margin by first producing product 2 to meet customer demand, and then by using any remaining capacity to produce product 1. Satisfying the weekly demand of 2,200 units for product 2 would consume 1,100 minutes of available capacity on machine A1. This implies that 1,300 constraint minutes would still be available to satisfy demand for product 1. Since each unit of product 1 requires 1 minute of A1 machine time, Ensign could produce 1,300 units of product 1 with its remaining capacity. This mix of production would yield a total contribution margin of $64,200. So, here's the information about colonial heritage. Is this enough hardwood to satisfy demand? No. Colonial Heritage needs 2,200 board feet to satisfy its demand. The company's supplier of hardwood will only be able to supply 2,000 board feet this month. What plan would maximize profits? Production of 100 chairs and 80 tables would maximize contribution margin. So here is more information about colonial heritage. Up to how much should colonial heritage be willing to pay above the usual price to obtain more hardwood? The additional wood would be used to make tables. In this use, each board foot of additional wood would allow the company to earn an additional $20 of contribution margin and profit. It's often possible for a manager to increase the capacity of a bottleneck, which is called relaxing or elevating the constraint, in numerous ways, such as the following. Working overtime on the bottleneck, subcontracting some of the processing that would be done at the bottleneck, investing in additional machines at the bottleneck, shifting workers from non-bottleneck processes to the bottleneck, focusing business process improvements efforts on the bottleneck, reducing defective units processed through the bottleneck. These methods and ideas are all consistent with the theory of constraints, which was discussed earlier. If a company has more than one potential constraint, the proper mix of products can be found using the quantitative method known as linear programming, which is covered in quantitative methods and operations management courses. Learning objective number 6 is to prepare an analysis showing whether joint products should be sold at the split-off point or processed further. So in some industries, a number of end products are produced from a single raw material input. When 2 or more products are produced from a common input, these products are known as joint products. The split-off point is the point in the manufacturing process at which the joint products can be recognized as separate products. So for example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, home heating oil, lubricants, asphalt, and various organic chemicals. The term joint costs is used to describe costs incurred up to the split-off point. Joint costs are common costs incurred to simultaneously produce a variety of end products. Joint costs are traditionally allocated among different products at the split-off point. The typical approach is to allocate joint costs according to the relative sales value of the end products. Although allocation is needed for some purposes, such as balance sheet inventory valuation, allocations of this kind are very dangerous for decision making. Joint costs are irrelevant in decisions regarding what to do with the product from split-off point forward. Therefore, these costs should not be allocated to end products for decision-making purposes. With respect to sell or process further decisions, it is profitable to continue processing a joint product after the split-off point, so long as the incremental revenue from such processing exceeds the incremental processing costs incurred after the split-off point. So assume the facts as we see here for Sawmill Inc. Sawmill has 2 joint products, lumber and sawdust. Selected financial information is shown for each joint product. The incremental revenue from further processing of the lumber and sawdust is $130 and $10 respectively. The profit loss from further processing is $80 for the lumber and $10 for the sawdust. The lumber should be processed further and the sawdust should be sold at the split-off point. Activity-based costing can be used to help identify potentially relevant costs for decision-making purposes. However, managers should exercise caution against reading more into this traceability than really exists. People have a tendency to assume that if a cost is traceable to a segment, then the cost is automatically avoidable, which is untrue. Before making a decision, managers must decide which of the potentially relevant costs are actually avoidable.